Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Frank Rottman, co-founder and partner and chief investment officer of QED Investors. We're going to learn how QED is advising companies as they navigate challenges of the economic environment. Frank, it's great to see you again. Welcome back to Trade Talks.
Glad to be here.
Let's talk about the current VC and investing landscape, including the most important conversation that's happening in every boardroom today. Give us an overview of what you're seeing.
The environment has shifted very rapidly from a period of risk on to a period of risk off. It means that investors are valuing profit over growth. They're valuing near-term results over long-term vision of founders. It means that really in this period, we have to navigate a seam because you're moving from one environment to another environment. And it's challenging. Founders are used to investing in long-term projects. They're used to talking about the narrative of their vision many years out. The patience that they have with, building a seminal company, which takes time, requires capital, is shifting right now, where a lot of emphasis is being placed on shorter term results and deliverables versus the longer term vision.
Frank, do you think that this valuation and expectation reset needed to happen a bit, considering the valuations that we saw in 2020 and 2021 and the types of companies that were coming to market? Is perhaps not going from one extreme to the other, but some sort of medium?
Yeah, every business is worth two things. It's a function of the ability for the business to actually produce results now, plus some option value on what the business can deliver in the future. And I think the period of the past few years, a lot of emphasis was being placed on what the business could deliver in the future. In fact, probably an overemphasis on that. I think the pendulum is swinging now that capital is less abundant, where there's a focus on what the business can deliver now or in the near term. And part of that's because it's not clear if a company runs out of capital, if it runs out of cash, like where that next check is going to come from. So a lot of companies have to be, a good steward of capital, and they have to make sure that they don't run out of cash. It's kind of the number one thing that businesses need to do, is make sure that there's capital to keep running. And so many of these businesses have a lot to actually figure out before they become profitable. And that means, either refactoring the business, how they manufacture things, whether they do things in serial versus parallel, how fast they hire. There's so many things that go into building a business from the ground up, that I think it's just a different way of building a business when capital, isn't necessarily going to be there when a company runs out of cash.
So Frank, at QED, what are you doing to advise companies and management teams?
Yeah, the first thing to look at is the actual business itself, and the people that are involved with running the business, the manufacturing process of whatever the product or service is that the business has. It really starts with the fundamentals of the business itself. And many times these businesses are running so hard for so long that if capital is abundant, the easiest thing for them to do is just hire more people to really take the burden off of the people that have been working very hard. And if you do that for a few years in a row, you end up with a lot of people in a company, and you have to question whether you need all of those people. So, the first thing to really look at is the staff, the OPEX and SG&A, the manufacturing process, and really stare at just the business itself and figure out if some decisions have been made over the past few years that need to be undone. The business might need to be more patient at the projects that it actually funds. The ambition of the founder might need to be spread out a little bit longer versus doing everything all at once.
Yeah. Frank, are there other areas within the investing landscape that are more attractive than others, specific industries or verticals that you take a look at?
So the real question is, are businesses solving a real world problem with very large addressable markets? And that's always been true. Investors like large TAM, they actually love businesses that, you're attacking incumbents that have very large profit pools. So all of that is still true. But in this market, I think capital light models are a little bit more interesting than ones that require a lot of capital in order to build out the business. If you think about a founder as a capital allocator, you give them capital in order to de-risk a business. And what they do is invest that in people, and they invest that in projects. and they invest that in growth. So the businesses that are more attractive now are the ones where you can learn the most, or you can de-risk the business the most with the least amount of capital. So it's less about an area of focus and more about, the capital consumptive nature of businesses relative to how much you can learn and de-risk.
Interesting. All right, Frank, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.